Okay, so now let's try to talk about accounts receivable valuation along with the discounts. So what happens is like accounts receivable is generally valued at original transaction amount, because at whatever amount you sell the goods, then the accounts receivable are being recorded at that, just like the historical cost. But what happens is like companies must adjust their value if they expect customer to take advantage of the sales discount. So there may be instances that the customer will take the sales discount or the company will offer the sales discount. So there are, I can say, sales discount cases. One of the cases like the cash discount. So the cash discount looks like in the offer letter, or I can say discount offer, the company may write the cash discount like 2 by 10 net 30, which means that this is a coding, or I can say general business parlance language, wherein it's like there will be a 2% discount if the payment is being done within 10 days. Otherwise the last day to pay is the 30th day. So it's like 2% discount if the payment is done within 10 days. If the customer pays after 10 days, but within 30 days he has to pay, there will be no discount. And after 30 days, there is no option to delay the payment. So this language looks like that. So what does this say? This encourages the customers to pay quickly, because the customer think, okay, in the 10 days I am getting 2% discount, so let's do and pay it right now. Companies that expect customers to take this discount must value the AR at the net realizable value the company they actually expect to collect. Now basically what happens, if the company has sold goods for $100 and they know that there will be 2% discount and people will take this discount, so effectively company know that they will be receiving only $98, right? So there is no meaning of recording your AR at $100. Instead of that, it should be recorded at $98, because they know that $2 will be taken as a discount. So the language looks like again 2 by 10 net 30, which means the customer gets 2% discount if they pay within 10 days. Otherwise, they need to pay full amount within 30 days. And what will be the impact on AR valuation? The seller is expected to receive only 98% of the gross sales as being mentioned here. Okay. Now let's see one of the real world example for this particular case. So there is a company whose name is Home Depot, and they sold $100,000 worth of lumber to the construction company. So they are supposed to receive $100,000 from the company, right? Offering terms by 2 by 10 net 30. Now Home Depot expects the customer to take the discount, because this happens based upon the past experience and they know that the customer will be availing this discount. So what will happen? They, Home Depot, know that their gross accounts receivable balance is $100,000, that this is the gross amount. Then the customer will be taking 2% discount, which is $2,000, that Home Depot expects the customer to take 2% discount. And finally the NRV, which is the net realizable value for Home Depot, will be $98,000, which will be like, this is the amount Home Depot records as the accounts receivable in the balance sheet using the net method. So this is an important method through which we can understand how the cash discount works.